Welcome to the FNO InsurTech podcast, a place where movers and shakers from all points within the insurance ecosystem gather and discuss all things InsurTech. We talk about how technology and innovation are affecting and driving change in the industry. Here are your hosts, Lee Boyd and Rob Beller.
Hey, podcast world, welcome to a whole new usage of our incredible, remarkable, super popular Joe Rogan Move Over.
It's a big deal.
Podcast.
Big deal.
That's right. Because our podcast, not for the first time, but maybe for the biggest time, is being used for a big announcement.
It's an FNO news event.
It's someone else's news event.
Not our news, but it's
not.
Edition of the.
It doesn't have a darn thing to do with us.
No, we have nothing to do with this.
No.
But we get to talk about it.
And I didn't mean to make it sound like Joe Rogan's going to be on our podcast.
Because that's not the case. He doesn't know our podcast.
No.
That I'm aware of. He may.
Yeah,
not that I know of.
He might be intimidated by our 4 listeners.
There's a chance.
Our 4 downloads that we get every week. Yeah.
Yeah.
But
you're really building this one up here, Rob.
But seriously, we have this is a special edition.
It is. I think it's a big deal. It's a big deal, and the longer we talk about, I think it's even a bigger deal.
So
I keep thinking about it.
So if I extend out our intro here for a while, it'll even be a bigger deal.
It'll be like a giant elephant. Like it'll be huge.
Your head might explode.
It might explode.
Well, then we should move things along because
I think we should.
I don't want to see that.
Because I bet the episode's pretty good.
So we have with us today for the second time,
2-timer,
a guy, and I'm going to just spill his name right now. Dan Reed, the top banana at American Family Ventures. Dan. So let me tell you a quick story. So a long time ago, when we were starting the podcast years ago, we decided that if we could have somebody on like Dan Reed, now there's a luminary, big name, big shot in our in the insurtech ecosystem. We could have him on. That'd be. I wonder if we could do that.
Yeah, we would have made it. I
sent him an email, and in like 20 seconds, he says, "Sure, why not?" And that is probably the best way to describe Dan Reed.
Yeah.
He, on the one hand, is the most gentle, nice, unassuming man, buried inside of this brilliant, highly successful exterior. And I'm not even talking about his baseball career here.
Right. Maybe
I'm talking about his career as a VC and inside of the insurtech ecosystem, and a brilliant man, a very successful man, but most importantly, a terrific guy.
He is a delight to talk to. A delight. I still remember when you said the very first time years ago that Dan was coming on, we all got nervous. We're like, "Oh, this is a big deal.
Mm-hmm.
It's a big deal." And today I'm still that way. I'm still like, this is a big deal.
Our friends at AFV Ventures reached out to us and asked, would we like to be the place where a big announcement is made today?
Yeah.
A big piece of news that is important to the ecosystem, to the insurtech ecosystem, highly relevant to the insurtech ecosystem, super honestly meaningful.
It is.
To the insurtech ecosystem. Would we house that? And we
said no. We said no. Oh, I kid.
We didn't even need to think about it. We said, absolutely, we'd love to, whatever it is. And so we're not going to spoil it here. We're going to wait until the interview, just in a second, starts.
We'll let Dan talk about it.
But we'll let Dan tell you. So before Lee goes and spoils it.
I almost did.
You almost did. You almost spilled the beans. We're going to get right to our interview with Dan Reed, Managing Director at American Family Ventures. Hey, everybody. We're here with a special guest, a returner, you might say, and this has a lot of different meanings, we put a call into the bullpen. And
Nice.
Thank you. And they sent Dan Reed out, the lefty. I called for a righty. They sent in the lefty. And we have with us today the managing partner. Did I say that right, Dan? What's your title?
That's good enough, yeah.
Okay. At American Family Ventures, in the continuing series of people who've been on our podcast, Dan was the first person from American Family Ventures, but not the only one. And thanks for coming out of the bullpen for us.
Thanks, Dan.
Welcome back.
Try not to be the last. So I was. So you're making a reference to the fact that I was a unsuccessful professional baseball aspirant, but you gave me some sort of traumatic memory here, because I was always a starting pitcher, and then every time I'd come out of the bullpen, it was a disaster. Like I never felt like I was part of the game. So you have these relief pitchers that come out with like songs like Wild Thing, right, or like Sandman. Mine would have been like Twinkle Twinkle Little Star. like
everyone slowly clapping.
Yeah, it was like, oh, this guy's coming out excellent.
Oh,
excellent.
Man, why this guy?
Yeah. But yes, I'm happy to be back. Thanks for having me back.
I hear it being played by like a 4-year-old with one finger.
Yeah. I did. I mean, I will say I did hear a marching band once play "March of the Sugar Plum Fairies," and it sounded so ominous, and in a way, it was like so metal that it stuck with me. Like 30 years later, like I can't.
Well, there you go. That might have been your music.
Could have been it. Yeah. Could
have been it sticking with you.
Well, we're not going to go down the path of reliving those years, although, as you know, there are millions of people in America who would give any part of the left side of their body to have had that experience.
Yeah, it was a lot of fun.
I bet it was. And no matter how far you got, you played professional baseball. That's cool.
Yeah, it was fun. I have a niece now. I'm visiting my family here in the Washington, D.C. area, and I have a niece who just had a chance to play in the 10-year-old national softball tournament.
Oh, wow.
Yeah, and it's intense. I mean, I didn't even start playing baseball until I was 10, and here she is in the nationals. It's just the parental commitment these days is completely next level compared to what it used to be.
It's a lot.
I have friends whose son is now a freshman in high school, and they just spent 2.5 weeks in tournaments. We're in California, in Atlanta, Georgia.
Yeah.
And I mean, you just drop everything, right? And the tail wags the dog.
Yeah, that's right. With 2-a-day practices and everything. But
yeah.
Thank goodness for the work at home environment.
Think where you would have been.
Burned out by sophomore year.
I'd have been in the exact same spot. Yeah, it would still wouldn't have worked out. But yeah.
Well, thank you. And thanks for taking a few minutes out from your vacation, I assume, to visit with us. We really appreciate it. So I have to start with this little story. So when we started the podcast, which was 2019, we really worked really hard in the beginning to try to get people on that we felt, from the little bit that we knew about insurtech, because we thought we knew something and we didn't know anything. And sadly, 5 years later, we still don't.
Yeah, I feel the same way.
But that's beside the point.
Exactly.
And so we thought, who could we get on who would be like an impact name? And we found Dan Reed.
Dan Reed, got to get Dan Reed.
And so I said to Lee, we're going to ask him to be on. I'm sure he probably won't even answer the email or the reach out. And so I think I sent him an email, and in like 10 minutes, he writes back, sure, no problem.
Sure, why not?
There's like nothing to it. And so
we knew we made it then.
Yeah.
That's right.
But, I was telling you guys before we started recording here that was the one podcast my mother's ever listened to. So you get, and I listened to it to make sure I wanted to send it to her. So you get two people listen to that podcast at least.
At least 2 listens.
So you didn't. So you made sure that there wasn't a bad story about your mother in it.
Right. I have to screen carefully for that, because you never know, right?
You never know. Yeah, we have that a lot. Well, when you do a podcast that's focused on insurtech, your audience is kind of limited to begin with. We mentioned when we started that both of our wives have listened to episodes that we forced them at gunpoint to listen to, and 2 minutes in, they're begging for us to shoot them.
30
Please,
seconds.
Use
30
the
seconds.
gun on me.
I heard enough. Thank you.
But anyways, all that aside, let's start anew, start fresh, and we're going to start with the specific reason why we have you here today, and that is kind of a big deal announcement in the world that we live in today from AmFam Ventures, and that is what, Dan?
Yeah, well, the last time you had me on, back in 2019, we were in the middle of fundraising for what was our third fund, Fund 3. But when you're fundraising, you're not allowed to talk about the fact that you're fundraising in a sort of open forum like a podcast. So I think I made some veiled allusion to it or something in that. But we finished fundraising for Fund 4 on Friday, and today is Monday when we're recording this. So I can say that we've now closed our fourth fund, and
congratulations.
Happy to be able to report it here first.
That is exciting. What an exciting time.
Yeah, it was fun. It takes a while to raise a fund. We started in the end of 2021. Actually,
wow.
It was talking to some of the limited partners, some of the investors that we had for Fund 3. You kind of start with the people who are already in the circle that way, and then we did the first close, so to speak. In the middle of 2022, and then you typically have like a year to bring in other commitments, and we just wrapped it up this past week. So we're happy to say we doubled the size of the fund from Fund 3. So that allows us to expand the team and expand the network a bit in what feels like a little bit of like a new wave of the insurtech space. But it's good to have some money to invest at a time when I think there's some uncertainty in the market, but there's still a lot of work to be done for sure.
So was the reception out there different for Fund 4 than it was for Fund 3, just based on the macro world that we're in today?
A little bit. It's not a great time to be raising venture capital. A lot of, most of the money that we raised is from the insurance industry. It's from carriers, and there are a couple of brokers in there as well, and a few individuals. But a lot of the people who make limited partnership investments for a living will talk about the so-called denominator effect, where when the value of their other assets is declining through public market activity or what have you, then you end up with an over allocation toward alternative investments, of which venture capital is one. And so it's a little harder to make the case that you need to be taking on more risk, or you need to bring on some alternative investment relationships into that portfolio when those are sort of organically increasing in weight within an investment portfolio. So that was a little bit challenging, and I think had a slightly diminishing effect. But what was helpful to us is we could start with a base of investors. So we had 13 companies backing us for Fund 3, and nearly all of them came back in for Fund 4, which is
that's
good place
great
to start. Yeah,
that's
and then
great.
and then we were able, during the process of investing in a Fund 3, we were able to build out our team and our capabilities and how we interact with these capital partners. And so we were able to offer some proof points about what is it that we do? How do we engage in a way that's maybe a little bit different from other investors that are a little bit less maybe strategic in nature as well. I mean, we certainly invest for financial returns, but there's a strategic engagement model that we have that I think is the heart of why we raised money from other parties. Our first two funds were just American Families Capital, but the last two have been this multi-limited partner model. And the reason why is kind of what we were joking about, right? There's just so much to know in the insurance market, in the insurtech market, in the technology market, that having more people, who manage insurance companies or the subcomponents of an insurance company, who do all that for a living. It just allows us to be a little sharper when it comes to making investment decisions and then making connections on behalf of the portfolio that develops, after we make those investments. It's just good to have a little bit of a wider network, and we were able to show a bit more to the new parties who joined us how that works and how that will work with our fourth fund here.
Is this a larger fund for you? I don't know. I don't know if you said earlier.
Yeah,
or
2x.
Yeah,
2x.
Fund one was $50 million. Fund two was 150, and then we took a little bit of Fund two and we put it into Fund three, which is 213, and then Fund four is 444.
Wow! So that's a big jump. That's big.
Yeah, it was a big jump. We were, when we were kind of ramping up to start this process back in 2021. If you remember, 2021 was like a super hot year for insurtech investing, for venture capital investing in general, and sort of back of the envelope math we were doing is, we'd have to raise a much larger fund to have the same investing power essentially than we did
because of the effect on pricing.
Yeah, pricing is up. Rounds were getting bigger. It used to be when we were starting out, 10 years plus ago, like a typical Series A would be $1 million on like a $4 to $6 million valuation or something like that. And some of that was we started in the upper Midwest, and maybe those are a little like showing my bias toward Wisconsin ecosystem, whatever. But that turned into like companies that really hadn't got to much traction yet. In 2021, we're doing things like, we're raising $8 million on, 32 million pre or something like that. And those numbers have come back down to earth to some degree. But when we were thinking about the size of the fund, that was definitely part of the calculus is how large do you need to be in order to. But then the other benefits are you collect some management fees based on the capital that's committed, and the management fees of a larger fund allow you to increase the size of the team, increase both in terms of the investors, but also in terms of the kind of what we call our platform team, which is kind of like a strategic services part of the business, services for the limited partners, but also for the portfolio companies.
You mean like advisory help? We're here to be a part of your strategic team. Yeah,
it's the way it works for the limited partners. Think of it as like an insurance carrier who would have invested in us. They want to get the financial return based on the investment that they make, of course, but what they're also really looking for is just some innovation opportunity flow. So, our case to a lot of these folks is we'll look at, with the investing team of now we have 13 investors, then we have 9 people on the platform side. The investing team will look at anywhere from 1,500 to 2,000 opportunities a year. Wow. Even at the moment when things are a little bit slow, they really try. The goal that we haven't found a great way to track yet, but the goal is that we never read about a funding event that we hadn't already talked to the company. So we're trying to see everything, and it's just hard to do unless you're kind of built for it and evolve into that. So a carrier that says we want to get some innovation opportunities started at our company, they look to us to say who are the 10 companies we should talk to this quarter, or we're thinking about it's even evolved to say we're thinking about something very specific. We want to do, a streamlined touchless claims process for something. Can you show us all the companies that could help us with that? And so for us, we make a point of sharing that flow.
That's so great.
Yeah. I mean, hopefully it makes us more valuable to the startups as well.
Right.
Because they're trying to meet a bunch of, carriers as sales opportunities.
So whenever you set up a fund, this being your fourth fund, is there a certain focus that you have? Is there a certain type of company you're going after, or is it just kind of like the other three?
Yeah. No, all of them have been kind of the same focus. It's early stage. So we used to call that seed through Series B. And then sometime in the last 5 years, those terms kind of lost their meaning. So now we talk about it as incubation. So, we'll get in at the very earliest opportunity through growth, which is, you're at 10 plus million in revenue. And it's that's the stage focus. And then for us, it's the centered around insurtech. And then a couple of areas kind of surrounding insurtech. If you think about artificial intelligence or even just things that change the context of risk management. If you think about autonomous vehicles or even climate these days, a climate related investment wouldn't be insurtech necessarily, but it would be certainly relevant to the homeowners carriers that are backing us. So it's kind of like a fun balance of defining what is our focus. We can certainly focus on early stage, but discovering what's relevant or what's likely to be relevant to the insurance industry is always an area of a little bit of creativity.
Yeah.
And,
you said that you felt that insurtech is in a particularly interesting place right now.
mm-hmm.
Is that kind of part of what you're talking about?
A bit. I mean, what I was thinking about is more. So I guess there's two ways to think about it. The first is I think it's always an interesting question to say what is the boundary of insurtech? What are the things that a carrier should be thinking about or having some exposure to, maybe through a high risk type of vehicle like a venture fund like ours, and things that come into that world, or like when is quantum computing relevant to the financial industry? It's coming. I think it's not quite there yet, but there's always sort of what's on the edge, and that's an interesting part of what we do. But more specifically, I think what I was talking about is just insurtech. It's like pure insurtech, new carriers or new companies that serve existing carriers. It's just in a strange, slightly stuck space right now.
Yeah.
Where there was continued growth in venture funding going into the insurtech space for years. I mean, I think going back to maybe 2012, every year was a new record in venture funding for insurance, and then it started being called insurtech, whatever, about 2015. 2021 was a high water mark. I think it was maybe $13 billion or so, up from like $7 billion in 2020. But then 2022 came back down from that peak. And I think the implications of that reduction in total funding are being felt by a lot of different companies, and it affects fundraising strategy. It affects, how you run your business as a startup. It affects how you run a venture capital fund, like ours. And I think everyone's kind of discovering what is the new normal, or is there a new long-term normal in terms of what it takes to get funded in the insurance market right now.
It changed the focus of what venture funds want their portfolio companies to, how they want them to behave and what they want to look at, right? It's
right.
I mean, like, for example, profitability.
Right.
Is that fair to say?
It is, yeah. I mean, if you think back to maybe like a 2019, 2020, 2021, where there's more and more capital coming into the space every year, then imagine if you're sitting on a board of a startup and, the question is where are we going to get the next round? And the answer is there's like money everywhere.
Right.
You don't need to worry about that.
Shake the tree.
Yeah. So what we should be focusing on is what's the biggest growth story that we can tell to the market, because the money's coming in, primarily in response to what feels like a big growth opportunity. And you saw the first wave of insurtech disruptor carriers hit the public market, and that growth story and the sort of inevitability of the next funding event, it didn't really hold up. Which created the first effect was the people who would fund that pre-IPO round, the sort of later stage, large check growth investors were pulling back a bit from the insurtech story. And that led to an immediate reaction that says, okay, well, maybe if growth potentially at the expense of profitability, isn't being rewarded the same way, then we need to be a bit more balanced in our approach. So we need to have enough growth that someone thinks this is a viable and exciting story, but we need to have enough of at least a narrative around profitability or a path to profitability that the risk that the next round doesn't come together is something that we can live with, is something we can deal with. And, so you started seeing, a couple of the companies where we have, board seats or sort of inside views, you started seeing discussions around, well, our growth plan is to grow 100% this year. Should we pull it back to 60%? Should we pull it back to 30%? Here's the effect on our cash burn. Here's the effect on our sort of years to profitability. And I think in every case, we were getting questions from investors around, are you guiding your portfolio partners to a more balanced story? And the answer was, yes, sort of. But we don't really need to guide anybody. Like that, everyone's coming up with the same conclusion, which to me felt like sort of the insurtech 2.0 story, right? Where now there's a lot of innovation to be done in the insurance industry. I don't think you can really point to any large carriers and say that they are as efficient, as innovative as they aspire to be. But I think that so there's like a lot of work to be done. But I think the growth at all cost model is not something that we get pitched really at all anymore. Yeah.
Is that what's important to your investors, though, now? Have you seen that change among your investors in general, where they're saying, we need to see the long-term viability of this company past just being able to scale?
Yeah.
Right?
Yeah.
Is this really a company on its own down the road?
For sure, that's the point. And I would put an even sharper point on it, where we had a meeting of our what we call our LPAC, our limited partner advisory council. This is a handful of our limited partners. We meet a couple times a year, and we met a few months ago, and we went through the portfolio from Fund 3, and I was able to report to them that most of the companies, or at least most of the value that we're holding in that portfolio, is in companies that have either become cash flow positive or have raised the money that funds the plan to get them to cash flow positive. And so that isn't just over the long term we're building sustainable businesses. I was able to report that a lot of them have already taken it upon themselves to get to that level of stability now. And they really liked it. They were a little surprised by it. The investors were surprised that they had taken those actions to get to that place. But, in the face of some uncertainty around where's the next round going to come from, I don't think you have to provide a lot of guidance to founders that think about what can I do to not have to raise that round, or at least not for a couple of years or something.
In with some of the startups that we've talked to, both on and off the record, that's on all of their minds, right? They have to look good. They have to be good at what they're doing, and they have to make that runway stretch out as far as they can,
right?
Because this is a story that's being written as we speak. I mean, if I said to you, so here we are in 2023, where are we going to be in 2025? After coming through the past couple of years, you would have some uncertainty around that. I mean, I'm sure you have thoughts on that. I don't think we're going back to 2020.
Well, you never know. The sort of magnitude of the changes is really hard to predict. But one of the things that I've been talking about, or I don't know, I call it like a rebuttable hypothesis. It's true until it just doesn't pan out this way, right? Is this theory of the second bridge that we talk about as a team, where in the face of a reduction in total venture capital in the insurtech space, and sort of particularly growth stage venture capital, a lot of I think there's a question about where are the exits in that environment. Why are companies not being bought by incumbents I think it's sort of part of a natural cycle. We just haven't seen that much of it. And I think a lot of it is because the insiders, the investors in a portfolio company will often do an insider bridge and buy that company, say, another year of runway to see, what happens in the macro environment, what happens specifically to fundraising opportunities. And I think a lot of those companies are in the second half of this year will be coming to a decision point around, are they going to do a second bridge? Where they've done one insider bridge, and maybe they did it in response to a lowball acquisition offer that someone offered, and the investors didn't want to take. Really, nobody wanted to exit at that point. And I think there'll be a lot of companies that come up on the second bridge, and discussions around, we didn't want to take that exit at half the price of the last round, so we bridged it for a year. But here we are again, and has enough changed to where we can raise more money and keep it going? Or did you get to profitability? Or, are we now willing to reconsider what's an attractive offer? So I do think we're going to see more exits in the back half of this year, moving into next year. And that doesn't get you out to 2025.
Right.
Well, that's okay. I'll let you off the hook.
But I do keep coming back to this point. I do think, the sort of long-term, we just raised a fund, right? And so we're going to be active for the next decade.
Yeah, you have money to spend.
Yeah, we do, and it's a nice time to have it. But I just think about the premise of our fund from the beginning was to make financial returns, but also provide innovation opportunities to companies that are already in the insurance industry. And that job is just not at all done. There's so much left to be done that I think there has to be real persistence in the innovation world within the insurance industry.
Are you seeing that? My sense is it's down from where it was.
Yeah, I think that it's become more focused. We see so now we've been working with, certainly American Family for 10 plus years. And then a lot of these other investors for now, we're in year 5 working together. And we see a very, in hindsight, predictable pattern where there's a lot of sort of widespread appetite for innovation at a company that wants to get involved with the startup world. And they do a bunch of pilots, and some things go into production, and maybe they buy, a company or what have you. But as time passes, every one of these companies gets more focused in what they care about. And they come back to us and they say, okay, it was great when we were having these wide-ranging conversations about just generally what are you seeing, what's on your mind as an investor. But in this next year, we want to focus on these three things. And, it's different for every company. Mm-hmm. But it's, we want to focus on, new distribution opportunities and, ways to cut expense out of our IT budget or something, whatever it is, and I think that's a productive, it feels like it's a narrowing, but I think it's probably more of like a deepening that we're going through right now.
Well, and like you said, we're so far, the industry is so far from mature in this regard that it's still a wide open field of areas where innovation may be welcome. Seems to me.
I think so. Yeah.
And it's interesting to me, even in a time where carriers, many carriers, particularly in the P&C markets, are struggling to stay above the break even. Yeah. Let alone make $1. They're nonetheless investing for the future in something like yours.
Yeah, I think that's true. I mean, it's I think the Wall Street Journal had a chart on this a couple of days ago. It was what the storm losses have been in the U.S. P&C market over the past decade. And, 2021, 2022, 2023, there are all outliers in terms of unexpectedly high losses relative to a 15-year trend line. And so, and we're seeing that just across the industry, it's definitely been. We're definitely in a moment where carriers are a bit more focused on what's the appropriate rate than how do we drive
Right.
a little bit of efficiency in the process.
I think that there's a lot to be said there. I mean, you read about companies losing money, quite a bit right now. Loss ratios are not where they want to be. Is there a focus on the insurtech side to help us price the policies better, to help us during this high time?
I don't know. I think we're certainly looking for it. The things that come to mind are, since so much of the unexpected loss has been in catastrophes. Where my mind goes is what can we do as an industry around climate change or
right.
better prediction of these exposures, and then where there's been a lot of attention over the past year, ever since ChatGPT launched, is just around what are the opportunities for AI, both in terms of efficiency within the value chain of the existing insurance company, but then also in terms of what might we not be thinking about, or
right.
what can we get from our own, how can we accelerate our own data science efforts?
Why does ChatGPT matter to insurtech?
There's a bit of a shift that I've observed where when we used to talk about AI, we used to talk about AI companies, and we've invested in a few, and some of them worked out pretty well. But there are companies that are developing AI capabilities where ChatGPT and the whole ecosystem of companies that are in that same category matter, I think, is now what we're talking about is every company should have some use case for AI. And we're not necessarily evaluating a claims company in terms of their ability to develop a new AI, tool. We're talking about their ability to use the existing AI tool set to make themselves more effective. It has the opportunity to turn AI usage into more of a table stakes category than it used to be even 3-4 years ago. It changes, in our view, the categorization of AI. Used to be its own category, and now it's part of our underwriting questions. Is how are they using AI, not are they on the cutting edge of developing AI?
Now, not are they making it?
Right, exactly.
Yeah, how are they using it?
But how can they use it? Can we talk about some of your portfolio companies?
Sure.
Tell us about Tire Agent. And I have to ask just because I love that name.
Yeah. Tire Agent. All right. So this is probably oversharing, but you've had Caitlin Johnson on the program a few times.
We have.
Partner on it too. And she loves being on it. And she's going to listen to this, and I don't know if she's going to be mad or if she's going to laugh at me for this, but Tire Agent was our longest investment committee meeting ever by hours. I mean, usually, usually the process that we go through, it takes up a lot of time, but it comes to ultimately it comes to a decision meeting that we call our IC, our investment committee, where we debate it, and then every member of the investing team gets a vote. Sort of a weighted vote as to whether we should go forward with the investment or not. And a long one, they tend to be scheduled for an hour, and then a long one will go for an hour and a half, maybe 2 hours. I think we took a break for dinner for Tire Agent, and the reason why was because at the time the way that we made decisions was it was me and 3 partners. We didn't have the whole team vote on it. It was really the sort of top of the hierarchy were voting on it, and all 3 of my colleagues and my partners were in favor of voting yes for Tire Agent, and I was in the no category, and I wasn't in the no category for any reason other than it was hard for me to make the connection to why an insurtech fund was investing in an online tire retailer.
Yeah,
and the team was trying what the team loved about it was they have the opportunity to be in the top 3 for for tire distribution, which obviously every car has, and like
they sell a lot of tires.
Yeah, they sell a lot of tires.
Yeah.
And it was really going well. I mean, they hadn't raised much money, and they were the sort of traction or trajectory of sales was really quite compelling at that stage. And so they were accusing me of being too tight when it comes to defining what matters to us, because, a lot of our money comes from the auto insurance industry. And Dan, I don't know if you've noticed, but, autos have tires on them. And I was like, yeah, but come on, like, how does that affect insurance? And it turns out that they were selling some insurance as part of it, and I was accusing them of falling in love with the traction and kind of rationalizing everything. And so we went back and forth forever on it, and they ended up kind of wearing me down. And eventually I was like, you guys are never giving this up, are you? And they're like, we are not ever going to give this up. And I was like, okay, fine, we'll move forward with it. And I'm glad we did, because the sales are up like 10x since we invested.
What is it? What do they do? Explain it to me.
It's just you need tires, Rob. We got your tires. Like,
You sell tires.
yeah.
and while you're at it, do you need insurance?
We
I don't understand
there's a financing component to the tires as well, and there's a collection, but of information that you can use for an insurance cross sale. But really, it was just about tires are a hassle to buy, and they just make it easier. Mm-hmm. And then where we did kind of come to a why us, and what was the fit between our fund and their business. This notion that we've been exploring for years that people now call embedded insurance.
Yeah.
But for us, it's just I think there's a real growth area in insurance distribution that's, well, you weren't thinking about insurance, and you'd probably prefer not to, but in the next couple of minutes, you may be receptive to a soft approach about closing a coverage gap that you may have, and we thought that they touch enough people in the tire business on a generally recurring basis that this could be worthwhile. And also, it's something that Amazon wasn't really in. It's kind of a difficult thing to just buy and have show up to your house, and so it's.
Is that how it works? They send you tires?
Yeah, they send it to wherever you want them to send. You can send
do they put them on at your house, or
no? You send them to your Jiffy Lube, or you send it to your mechanic or whatever.
You buy it, they ship it, somebody else puts it on.
Yeah.
You just get a good deal on tires.
Yeah, and it's a bit of a lesson for me about overthinking the strategy sometimes. It's a good online business that hasn't been as subjected to pressure from Amazon or others.
Uh-huh.
Yeah.
And it's run by a leadership team, a founder that comes from that space and had a lot of relationships that I didn't fully appreciate at the time. And it was I'll say, like, I told you a little bit of the story about, like, it was a big fraught decision or whatever, but it was actually a little bit of a inflection point in our practice where I think it was the first time that I essentially got outvoted and just said, "Oh, okay, you guys are," and it felt really good because as we've grown the team, we've
you want that.
Yeah, you want that.
You want that.
And now we've got a lot of people that serve on boards and lead investment discussions, and I think the sophistication of the discussion improves. The more experience everybody gets, and that was a good moment for us.
So you have a big responsibility. I mean, fundamentally, a bunch of people got together and gave you a bunch of money to spend, and that's a big responsibility that you have to allocate it. Do you, when you are looking at somebody like Tire Agent that's not normative, do you have to go back to your LPs or to your investors and say, "Hey, we're thinking about this," or do you have the decision-making authority singularly?
We have the decision-making authority. It really has to be that way.
Of course.
Just because of the speed. But we are to your point, we're very accountable to the results, to the process, to the reasoning. And, we report out every deal that we do, and we tell our limited partners after the fact why we did it, and sort of on record as to, well, at least explaining why we thought it made sense at the time, and we'll see how it turns out over the course of time.
One of my questions early on was kind of what is your selling point to the limited partners to get them to invest, but around that I want to talk about one of your more famous portfolios, companies in the portfolio was Ring. Mm-hmm. Right? You saw that one in 2018. It got acquired by Amazon. Tell us about that. I mean, was that an interesting ride?
Yeah, that was a fascinating. There was so much that I could talk about with Ring. So you've had Kyle Nakasugi on the program. Kyle's the founder of ClearCover, but he was with us at the time we made the investment in Ring, and Kyle led that deal. For us, it was maybe our 13th IoT investment. We had been exploring a thesis that homeowners insurers were sort of an overlooked distribution partner or sort of party to the growth of the home automation space. Yeah. It's like 10 years ago, it was novel. Now it's sort of just generally accepted
right.
as a notion. But at the time, we felt like we were breaking some real ground there. And so we were investing in water sensors and smoke alarms, things that an insurance company cares about. And part of the work and distribution pilots and seeing how some of those investments went, it did make us recognize that homeowners care first about. I mean, they certainly care about fire and water damage or whatever, but they really care about someone breaking into their house, and significantly disproportionately to the insurance risk of that happening, where that, so theft claims represent less than maybe 1% of the total homeowners insurance claims, but it's what people start with when they think about outfitting their house. And Ring had a solution that was, I think, compelling from a price point of view, and it had this, view it on your mobile, and
it was brilliant. It was brilliant.
It was great, and they were spending money building a brand. I mean, Kyle and I had a moment where we were having lunch, back when people had lunch with each other. It was
back when you saw people.
I know, and I looked over his shoulder at this TV in a bar in Madison, and there's Ring on national television, and it was such a cool moment. We were maybe like year 3 of investing together, and to see one of our companies now on national TV, I mean, just a couple months after we'd invested in them was really fun. And then every time we talked to Jamie Siminoff, the CEO and founder of Ring, it was just good news. It was like, we expected to do $8 million in sales this month, and we did $20 million in sales. Or, Costco picked us up, and it's 3 times what we. It just sort of ran away, and then Amazon bought them, and it was great. But that was one where we definitely started with a thesis of connectivity to the insurance industry, and it took us a while to get to one that was a kind of a breakout like that. But that was very gratifying.
Has that happened again? Maybe not to the same scale, but
yeah, there've been a couple of others that the thing that everybody talks about is the nature of returns in a venture portfolio, where the way that investors talk about it is that it follows a power law, and the kind of non-mathematician way of describing that is the number one return for your company, the sort of company that the investment that you make that pays off the best is going to pay you back more money than the rest of the returns combined. And then the second one is going to pay more than the third through N, combined. And so we've had a couple. Ring was a good one, a really good one that helped us kind of build some momentum. But we've had a few others along the way, and then we have a few more, knock on wood, on that track. That, yeah. But you asked Lee, what was the story that helped us raise money? It was a bit of credibility as an investor. So we have to be able to show some of those returns. For us, it has to. In every case, there were 3 people with like the nuclear keys or whatever, like they all had to turn the switch at the same time, and it was always the chief investment officer who looked at our investments over time and looked at the things like the IRR on the fund, or whatever metrics they would consider, to think is this a justifiable decision to the finance reporting chain. And then there was often like a chief operating officer or a chief innovation officer that was thinking about how do we access deal flow for our own innovation purposes. And then ultimately there was the CEO, and the CEO was typically thinking about cultural story, which is, we want to get involved in this. We want to get our employees, thinking in more innovative ways. We want to, start some partnerships, and I want to be able to answer to the board that we're, investing in this space where we're seeing every year more and more investment going into this. And so when all three of those aligned, we were able to do it. I think the thing that worked in our favor, or has worked in our favor, is that chief innovation switch for us. We do invest pretty heavily in making those connections between the startup market and our investors. And we do it certainly to be able to raise money, but we also do it, it makes us smarter. There's so much to know about it's so much to know. It's completely humbling to me. I've been in the insurance industry for 18 years, and I swear there's not a week that goes by where I don't feel like, wow, I can't believe I didn't know that. That's a whole thing that I didn't even understand it. And now we have 20 plus investors that we can call. Somebody's got some experience there that we can get a little smarter.
And they must enjoy that.
They do, up to a point, Rob. Yeah, I mean, it's like
it's Dan Reed. Tell him I'm not in. I'm not in.
First 12 times we call them, it's all great. And like after that, it's like, good God, like give me the weekend or something. But, we've definitely worn some receivers out. Is kind of how we thought about it. So we created a program to create more receivers. We call it Venture Fellows, where we for our investors, they can send people to our little conference that we do, and they send people from all over their organizations. We've had agents go through, we've had senior VPs go through. Like it's been, and we talk about what does the venture capital market look like? What are some of the spaces where we invest? What's it like to run a startup? What's it like to work with a startup? And it's and the hope is that there's more people sending us thoughts, and more people that we can send connections to. And that's been something we've been doing 5 or 6 years now, and it's worked pretty well.
I have another question about another company. Branch is run by, certainly, I mean, you talk about brilliant people in the insurance business, or
yeah, you stole my line on that one. Yeah,
I mean, that you sit down and talk to Steve Leckus for an hour, and it's like, oh my God, I just attended a PhD level course in insurance here. Yeah. And great guy, great company. I love everything about it, except that they're not available in California where I live. And
maybe someday. Yeah.
Yeah. It's I bug them about it all the time. And so, but they hit this, did they hit a big bump in the road, or was it just a readjustment of how we have to look at things based on several things that we've talked about today, that things have changed, and we need to operate strategically differently based on the times that we're in?
I think it's that. So I totally agree. I mean, but don't forget about Joe as well. Joe is Steve's co-founder, and
yes,
the two of them are really, really sharp. We'll have Steve speak to our team from time to time, just as a little bit of calibration for this. This is what someone who really knows the stuff looks like.
Yeah.
And also just, what should we all be thinking about as well? So it's so Steve and the branch team have been doing well. I would say Steve would tell you this, I think, so I don't think I'm giving away anything. And I don't sit on Steve's board, so I'm not truly on the inside here, but Steve has, before we got to what I referred to as InsurTech 2.0, this idea of balancing growth and profitability, Steve built his company based on that thesis when we were still in an InsurTech 1.0 world, where, he was saying from the start, we need to be the group that's the most capital efficient, that's able to get to profitability able to get to scale and able to get to profitability faster than the predecessors, because we're building off of a playbook that other people have demonstrated. And when he's talking about the playbook, he's not talking about the insurtech predecessors. He is, but he's not only talking about them. He's talking about, he's a sort of a historian of the insurance industry. And so for Steve, when the capital market changes, he'll make the adjustments to his, to his runway management. And, he unfortunately had to reduce his, size of his team a bit to make sure that he is able to still deliver against the premise that he's been building all along. And, I think the idea of doing a team reduction of displacing people, I haven't ever been a founder who doesn't take that extremely seriously. I mean, we'll talk to founders about trying to elicit from them a sense of obligation to us as their investors, and the people who back us. And they very rarely have any sort of like moral obligation that they'll express about, returning the money to their investors. It's always about, I hired these people, and, and we've created a culture, and we've created a team, and people took a chance on me. And I feel like that's my duty, is to keep that going as best I can. And Steve definitely is of that mindset.
I want to get back, ask you another question about the current fund.
Sure.
When you do a fund like that, do you have a list of specific areas that you're looking for, or maybe there's some of that's allocated, like, to these ideas, but the rest is just, free agent money? How do you budget it?
Yes. So we do a few things, and I'll try to keep this one short because we can get too into the weeds here. We, as I mentioned, we have an investing team of 13, and we have a number of other people who are supporting the operations of the firm. But those 13 people, they will. We did this exercise recently, sort of reformatted it, but they're calling certain geographies as areas of interest for them. For example, I'm going to be spending more time in Seattle than I have before, and another person is saying, they want to understand what's happening in the Denver market or what have you, right? And it's not so much that they have like a franchise in that territory. I mean, anyone can go wherever they want. It's more like I'm just saying that I'm going to go meet everybody that I can meet in Seattle over the coming year, right? So they'll do a geographic lens on it, and then they also have a thematic focus area where someone would be looking at all the claims technology companies that I can find, or someone's looking at all the property technology, or whatever, right? And what we found is people develop certain centers of gravity on the team where, if you've talked to 25, claims companies, you start to see some patterns that allow you to be a little bit sharper when you talk to the 26th one. Mm-hmm. And that allows you to maybe get into the 26th investment if that's what you want to do, because now you're a little bit more credible. And now you're sitting on the board of that company, and you get a little sharper. And then the next one comes along, and it sort of naturally starts to build that way. We're kind of focused that way. But then your question was, how do we budget for that? That's more of a strategic planning aspect. How we budget for it is we have a deployment model that we share with our investors, both our investing team members, but also our capital providers, where we say, we want to have this many portfolio companies, and we want them to be at, this many at the seed stage, this many at Series A, this many at Series B, and we sort of track our deployment against that. Against that model. You don't want to become over concentrated into any one company or any one concept, and you want to maintain. So, but you also want to maintain some flexibility around what is it that you're actually seeing, and what is it that you're really getting excited about. So we have a sort of loosely adhered to deployment model and geographic and thematic focus.
So not only do companies find you find companies. So you're shopping, and people are knocking on the door also.
Yeah, and you're talking to friends who are investors, and I mean, what we're hoping for is that say you are, a Series A company and you're starting to get organized around your Series B, we want the people that you talk to about who should we go pitch. We just want to be on that list. We just want to be on the list of 5 or 10 investors that everyone wants to reach out to. And
that makes sense.
I think you are today.
We try to be, and it's not always the case, and that's a mix of outbound, outreach, but also getting to know people who are also investors, and then getting to know companies and backing people on their second startup or whatever. And yeah,
in the marketplace, the VC marketplace, has it shrunk around insurtech? Is it smaller, less sexy than it was, so therefore people have moved on? Or
there are very few insurtech, firms that would call themselves insurtech funds. There are very few of those who've stopped being funds. One or two of the kind of pure corporate funds have stopped, but really no news on that front. More of what's happening are growth stage general firms that would do an insurtech deal, but it isn't what they would call their focus. They have been they've shifted to other sectors to some degree, and I think it's all of our job to shift that back over the next few years.
Mm-hmm. I just want to ask you a couple more questions, and thanks again for being so generous today.
Sure.
You talk about insurtech 2.0. We've heard different definitions of insurtech 2.0. What is yours?
Insurtech 2.0 is a more deliberate balance between growth and profitability, and an explicit narrative around the timeline to break even.
Does it also refer to the kinds of companies that you're seeing today?
Yeah, I think that more the stories that they would tell about their plans. It's not like we've seen a major shift in what types of companies there are out there, but we've seen a significant shift in how they expect to be funded over their lifespan.
Are you seeing like companies like branches where they're MGAs or insurers coming to market, the Hippos, the branches, the Lemonades? It seems like there's less action there.
Well, there were never that many of them, but yeah, I would say there are fewer. It's not like we see 10 a year of companies who aim to be a carrier just because it's expensive to get there. I think that's a benefit to branch, to clear cover, to the companies that are out there and established and growing and trying to get it on an IPO path, that they're not at major risk of immediate disruption from someone coming up behind them faster. But I think that was always a really small part of the insurtech ecosystem, though. I mean, there are always more companies looking to work with the existing carriers, the existing market, than there were companies that were trying to compete directly with the types of companies that backed us.
Last question.
Sure.
So why is it that left-handers have such longer careers? Why is it? What is it about being a southpaw? Is it that there's just fewer of you?
I'm gonna chalk that up to the question I got from my former father-in-law, who would ask me when I was playing in the minor leagues, and he would say, when are you going to go pro? And I was like, man, I already am pro. Like, what are you talking about? But then the other question is, people from time to time tell me, you were a left-handed pitcher, huh? I thought all left-handers had to do was throw strikes. And it was like, well, I'm sitting here talking to you as an insurance guy. So I guess I didn't do that either. But no, I just think it's demographics. There just aren't as many left-handed people. But what I don't understand, what the real question for me about baseball is why does everybody throw 95 miles an hour now?
How did that happen?
Yeah, it was like genetic modification or something happened in the last. I
think GMO, decade. Right?
Yeah, maybe. Drinking their milk.
That's a great question. I mean, I grew up a baseball fan, somebody who could throw in the mid to high 90s was like a superstar.
Yeah.
Right. I mean,
first round draft pick every time.
That was Sandy Koufax. Now, if you can't throw like that, we never even hear of you.
Yeah. Unless you're on a insurtech podcast.
That's right.
Yeah.
Well, we don't hear about you when you're playing ball, but we do hear about you when we trap you in a corner and force you to be on a podcast for the second time. I
appreciate you guys having me on.
We're so grateful that you were able to come on.
It's great. And have a good time in Washington. Will you go to a Nationals game while you're there?
Yeah, we might go do that.
Oh, that's fun.
You got to enjoy yourself some.
Yeah, a little bit. Yeah.
Well, thank you so much, Dan.
Thank you, guys.
And I just want to say, we not only do we appreciate the fact that you've done this, but we appreciate what your org is doing for our industry. It's really important, and not just with the investments that you make, but providing kind of some leadership around how a VC should work. And I think that other investors look at you guys and say, here's a model for how to be successful. That's great. Thank you.
Well, thanks for having me. I appreciate that, and thanks for what you do too.
Oh, sure. That's the easy part, because we just fake the whole thing. To me, for my money, Dan is one of the most interesting characters in the ecosystem.
I would agree with you. He has. We can actually see Dan during the interview, right? We don't show our guests that, but we're all on video, and to see Dan's wheels just turning while he talks is fascinating. He has so much knowledge, and it all comes out so effortlessly.
Mm-hmm. Mm-hmm.
Yeah.
He's one of those guys that everybody likes. He's incredibly likable. And, and yeah, we can't thank him and his team enough. We're honored to be the place where they have announced their latest fund.
Yes.
Completion. Congratulations. And of course, they're always welcome here, as we've had many members of their team on. And we're not even going to mention Caitlin Johnson's name, are we?
Right. We wouldn't want to drop her name on another episode.
Don't want to say Caitlin Johnson.
Yeah, Caitlin, we wouldn't want to say that name.
Because how many times has the name Caitlin Johnson come up on this podcast?
Well, quite a few now. So, but yeah, we wouldn't want to say Caitlin Johnson.
Never going to say Caitlin Johnson's name again.
Right.
Especially when it's not her episode.
Right. We wouldn't want to take away, any glory from Dan and talk about Caitlin Johnson.
By saying Caitlin Johnson.
Who's been on the podcast more than Dan. But we wouldn't want to say that. We wouldn't want to say that. Who's
almost been on the podcast more than us.
That is true. That is true.
So thank you, Dan and team, for being with us today. Thank you to our team for making this happen. And thank you to you, the listener, for being with us. And until next time.
Goodbye, everybody.